So this is the second part of the 17 ratios that you should know when you're giving your CBSE or ISC paper. And we already did the first 5 ratios in our part 1. It was the current ratio, quick ratio, debt to equity ratio, proprietary ratio, and debt to total assets. Right? A current
Yes.
ratio is current assets over current liabilities. Quick ratio is quick assets over current liabilities. It would be your current assets minus your closing inventory. This is your quick assets. Debt to equity ratio is your debt over equity. Debt means your long term borrowings, and equity means your shareholders' funds. When I talk about proprietary ratio, how much of your total assets is funded by your equity? So the formula was equity over total assets. Debt to total assets, how much of your total assets is funded by your debt? So the
That.
formula is debt over total assets, where your total asset means your non-current assets plus your current assets plus your investments.
Yes.
Okay. Debt to equity tells you what is the proportion of your loan funds over own funds. Now, the next part, the next 5 ratios that we're going to discuss over here is your interest coverage ratio, your activity ratio, that is means your trade receivable turnover ratio, trade
Turnover
payable
ratio.
turnover ratio, working capital ratio, and your inventory turnover ratios. Okay, so let's go to the sixth ratio that I am looking forward at, interest coverage ratio. What is interest coverage ratio?
It measures the ability of the company to cover interest expenses.
It measures the ability of your company to cover your interest expenses. That means what? Interest coverage ratio is basically telling you that your net profit can pay your interest charges how many number of times. And the formula for interest coverage ratio is net profit before interest. Before
Yeah.
interest and before tax. Yeah? Net
Yes.
profit before interest before tax divided by your fixed interest charges.
Yes. Fixed interest charges.
What does your fixed interest charges mean?
That.
Fixed interest charges means your interest on your bank loan, your interest on your non current liabilities, wherever there is a percentage that is given to you. So your
Yes.
net profit can pay your interest. How many times is your interest coverage ratio? Ability to cover your interest expenses over your operating profit. How many
Profits.
times you can pay your interest expenses is interest coverage ratio.
Interest coverage ratio.
For the interest coverage ratio, you should always know your income statement. Do you know your income statement?
Uh.
You have your revenue. From your
Yeah.
revenue, you minus your cost of sales. What you get is your gross profit.
Yes.
Okay. From your gross profit, you minus your operating expenses. What you get is your
Expenses.
operating profit. When you say you minus your operating expenses, what is your operating expenses covered of? Operating expenses, your administrative expenses. It is your
Yeah.
administrative expenses. That means your office expenses and your selling expenses. Are you with me? Operating
Yeah.
profit is the profit that I am looking at. Operating profit is the net profit before interest and tax. Are you with me?
Yes.
From this, you will minus your finance cost. That means all your interest expenses. Okay. You will
Yeah.
get net profit before tax.
Yes.
You will minus your tax, and what you get is your profit for the year.
Yeah.
So In your net interest coverage ratio, what you do, you take your operating profit over the fixed interest charges.
Yeah.
Okay, so how many times your operating profit is able to cover your interest expenses? Net profit before interest and tax. Net profit before interest and tax is also called your operating profit
Yep.
divided by fixed interest charges. Now, trade receivable
Which
turnover ratio. What does this tell you?
yeah, it indicates the how efficiently company collects revenue
How
from its
efficiently you
receivables.
are collecting money from your customers, the credit
Yeah.
customers. Okay, so how do you get this?
Trade receivable turnover ratio. Credit revenue from operations over average trade receivables.
What do you mean by credit revenue from operation?
And, uh,
It is your trade receivables. Trade
yeah.
receivables are those people to whom you have sold the goods on credit.
Yeah.
You have sold the goods on credit, that means your revenue is on credit. Credit
Yeah. On
revenue
credit.
from operations. Okay, so trade receivables over
Trade receivables over the average trade receivables.
okay, fine. Listen to
Yeah.
me. Okay, if you have trade receivable over credit sales into
Oh.
365, okay, trade receivable over
Yeah.
credit sales into 365, this is going to be
365.
what? Ye-
Credit revenue from
The days,
operations.
the days in which you are going to collect the money from your trade receivables. Okay,
Okay.
these
Okay.
trade receivables would be your average trade receivables. What will this be? Your average
Yeah.
trade receivables. Okay. If you
Average
inverse
trade,
the
trade
formula, if
receivables.
you turn over the formula, if you do credit sales over trade receivables, you will get the answer in times. Okay. This
Yeah.
credit sales is nothing but this is your credit revenue from operation.
Credit revenue from operations.
Hmm. What is your credit sale? This is nothing but your credit revenue from operations.
Credit revenue from operations. Yeah.
Are you with me?
Yes, yes.
So your credit sales is your credit revenue from operations divided by average trade receivables. In how many days? So when I talk about the trade receivable turnover ratio, you can have the ratio in days and you can have the ratio in times.
Yeah.
Okay. If you do directly average trade receivables over credit sales into 365, you will get your answer in days, in how many days you are collecting your money from trade receivables. If you inverse the
Yeah.
formula, you do credit sales over average trade receivables, you will get your answer in times. How many times in a year you are collecting money from your customers?
Collecting money from. Yeah.
Now, trade payables turnover ratio.
Yeah.
Again, this would be in days and
Time.
okay. Just take the trade payables over what?
Credits.
Credit
Credits.
purchases.
Purchases. Okay.
And this trade payables is average trade payables, okay?
Yeah.
To 365. You will get your answer in days.
Days.
If you inverse the formula, credit purchases over trade payables,
Credit purchase over trade payables.
then what?
Right. We'll get
Then
it in.
okay. You will get your answer in times.
Okay.
Okay. Now try doing it. Now we talk about working capital turnover ratio. Okay.
Yeah.
This tells you what is the efficiency of your revenue generation from your working capital? That
Working
means
capital.
using your working capital, how much revenue you are generating. Using your working capital, how much revenue you are generating. So
Revenue
it
we're
would
generating.
be your revenue from operations.
Yes.
Revenue from operations over the working capital. This is going to give you your working capital turnover ratio.
Ratio. Yeah.
Okay. What is working capital?
Working capital is the current assets and current liabilities
Current assets minus the current liability.
minus current liabilities.
Current assets minus the current liability would give you the working capital turnover ratio. Okay.
Yeah.
Now, what you can do is we always try to find the answer in times. Okay. For
Yes.
all these ratios, for which all ratios? First is the trade receivable turnover ratio. Can you please write it along with me? For the
Yeah.
trade receivable turnover ratio, for the
Yes.
trade payable turnover ratio, for the working capital turnover ratio. We always try to find the answer from in times. Okay. So this
Yeah.
would be credit revenue from operations.
Yeah. Credit revenue for operations.
Okay. This would be your credit purchases.
Yeah.
And this would be your revenue.
Yep. Revenue.
When I say credit revenue from operation, what does this mean? This means credit sales.
Credit sales. Yeah.
Okay, what does this mean? This means your credit purchases.
Credit purchases.
And this means your total sales.
Total sales.
Okay, so whenever there are turnover ratios, trade receivable turnover ratio, trade payable turnover ratio, working capital turnover ratio, and there is one more turnover ratio if you remember,
Working capital.
inventory turnover ratio.
Yeah.
Okay, I will talk about this a little bit later. So whenever there are these turnover ratios, your numerator would always be your revenue.
Yeah.
Okay, so your trade receivable turnover ratio, you will have credit sales. Trade payables turnover ratio, you will have credit purchases. Working capital turnover ratio, you will have total sales. Now, when you're going to divide it, okay, come on. Here you're going to divide it with your average trade receivables.
Average trade receivables.
Here you're going to divide it with your average trade
Average
payables.
trade payables.
And here you're going to divide it by working capital.
Working capital. All right.
When I talk about average trade receivables, means what? Means your opening trade receivables plus closing trade
Closing
receivables
trade
divided by
receivables.
2. When I talk
Yeah.
about average trade payables, means what?
Opening trade payable plus closing trade payable divided by 2.
Trade payables plus closing trade payables divided by 2. And when I talk about working capital, means what?
The same
Current
thing.
assets minus current liabilities.
Current life. Oh, okay. Yeah, yeah.
Okay. So you have three that I have discussed. One is trade receivable turnover ratio.
Yeah.
In how many times you're going to collect money from your trade receivables?
Trade receivables.
How many times you're going to pay?
Pay.
What
Yeah.
does the working capital turnover ratio tell you?
This that efficiency measures the efficiency of revenue generation.
To generate working capital.
Yeah.
Okay. So trade receivable turnover ratio would be your credit sales over average trade receivables. Trade payable turnover ratio would be your credit purchases over average trade payables. Working capital turnover ratio would be your total sales over the working capital. Okay. Inventory
Okay.
turnover ratio. What is it? How many times you convert your inventory into cash?
Cash. Okay.
How many times you convert
You
your
convert your inventory
inventory
into
into
cash.
cash? So, what would be the formula for this? See, in all the turnover ratio, turnover means sales. Okay, turnover means sales. So, in all your turnover ratios, your numerator would always be the turnover, your numerator would always be the sales or purchases. Are you with me?
Yes.
So, in inventory turnover ratio, again, it would be your sales
Yes.
divided by what? Divided by
Inventory
average
turnover.
inventory.
Average inventory.
Divided by average inventory. So if you're going to divide it by average inventory, you're going to take your cost of sales. How do you
Yeah.
get average inventory? Opening inventory
Opening inventory
plus closing
plus
inventory
closing inventory divided by 2.
divided by 2.
Right.
Okay. So inventory turnover ratio tells you how many times you convert your inventory into cash. So these are your 4 turnover ratios we discussed: trade receivable turnover ratio, trade payable
Yeah.
turnover ratio, working
Turnover
capital
ratio.
turnover ratio,
Turnover ratio.
inventory
Inventory
turnover ratio.
turnover ratio.
And we discuss interest coverage ratio. Now, what I want you to do is pause the video and write all the 5 ratios, but try to write without seeing. Okay?